Let's get some news or some insights on the news that's shaping the markets. And for that, we welcome in Kevin Gordon, Senior Investment Strategist at Charles Schwab. He joins me at the desk. Kevin, so good to have you here.
Hi,
Thanks
Caroline.
for kicking off the week.
Been a while. Good to see you.
Yeah, it has.
Yeah.
So it's stocks in rally mode this morning,
Yeah.
seeing lots of green arrows. But you think any rally could be limited. Why?
Well, limited if you don't get, with the qualifier, if you don't get breadth statistics that start to improve. So actually, evidenced by the move this morning, a lot of the rebounds being driven by names that have severely underperformed, not just over the past couple of months, but really year to date, and actually even since last year, since the market's low last year. So small caps are included in that portion. Anything down the cap spectrum, anything more cyclically oriented is what's leading today. So if that's just a head fake, we need a little bit more time to sort of see if that's the case. But if you start to see breadth improve under the surface, which it really hasn't over the past couple of months, then I think you could probably have stronger legs into the end of the year. But if it doesn't, then you're going to have more of a thin rally like we had, at many points earlier in the year. And I think that would be sort of a negative divergence where you start to see some more material breakdown under the surface. I'd be more on watch for that than I would some of the headline indexes and what they're showing.
But given the fundamentals, because this market certainly has a fair share of headwinds right now, can you make the case that breadth should improve?
You can. I think you have to, certainly for earnings season, I think it's coming at a good time where you have had a deterioration in breadth since July, since the most recent peak in July. And if you start to see, particularly with what we're most focused on, a rebound in not as much earnings growth itself, but actually sales growth. Because revenue has been, I think, the more of the pain point for a lot of firms. You've had basically no revenue growth in the second quarter. You're expected to almost hover in similar territory as of now for the third quarter. And then in inflation-adjusted terms, you're actually still down. So you really need to see that start to turn, because if you have revenue growth that's declining, but you have earnings growth that's picking up, that means earnings are sort of growing for the wrong reasons, with aggressive cost cutting being the case. So you need to see that dynamic, I think, clear itself. And it's probably not going to get solved in one quarter, but if you get a more solid trajectory in terms of earnings estimates throughout the quarter, you start to see more of a stabilization in things like ISM manufacturing, some of the regional PMIs, some of the housing data, which we get later this week, then I think you probably build more of the fundamental case, but you're not quite there yet.
Well, let's talk about your expectations for earnings season.
Yeah.
We're still in the early days. So far, so good, although some may argue it's just that expectations have been lowered so much. Earnings season really picks up steam this week with some big names like Tesla and Netflix. What are you expecting?
Well, I think overall the trajectory is probably correct in terms of what analysts are expecting, in terms of that hook pattern you keep seeing first quarter and second quarter. That was the case. But I think maybe in terms of bringing it back to realistic expectations and what is to be expected now that you're almost 2 years into the Fed tightening cycle, this is typically the time you start to see more hits to the labor market. A lot of the headwinds for labor haven't cleared, in our opinion. That doesn't mean that earnings need to go back down and you need to go back into an earnings bear market, but flat to no earnings growth is very different than double-digit earnings growth when you've gone back into a durable cyclical recovery. So I think that's probably what needs to be explored more. And back to the point on revenue growth, that was the focus, in our opinion, in second quarter, because you had seen basically no reward from the market for even names that were beating earnings estimates and earnings expectations. So if that happens again, which I would argue Friday was a little bit of sort of a precursor to that, because for all the excitement about some of the big beats for bank earnings, the bank index closed lower. It gapped higher initially in the day, and then it wiped out all of the gains. So if that excitement continues to fade and you start to see more of that pattern, then I would probably take a little bit more caution and look for certainly names that are up in quality across the spectrum, but especially with the interest rate environment that we're in right now, you have to be much more focused on quality parts of the market.
Okay, and it seems like this market is largely shrugging off some of the geopolitical risk that we're facing, but as those risks globally appear to really mount, where should investors be seeking safety? Or is that the right strategy? You mentioned quality, but are there safe plays out there amidst
there's a couple of ways. I think for safety in the equity market, the quality approach, not necessarily from a sector standpoint, because actually since the July peak, we've been in this downtrend. If you were to go to the traditional defensives, staples, utilities, those are the two worst performing sectors since July, and they've got their own sets of issues. But I think for especially a sector like utilities, something that's heavily indebted, doesn't have a really strong interest coverage ratio, really gets hit by higher interest expense and that buildup in debt over time. So when you combine that and the fact that yields have gone up, not only are they suffering from that, but also just the sort of competitive nature of yields across the board, across the curve. So you can play defense in the equity market by staying up in quality, but you can also play defense in the bond market. From an income hedge perspective, we think that works really well. Our chief fixed income strategist, Kathy Jones, has been arguing for this for a long time this year, saying that if you're wanting to extend duration, now is probably the time. So there are a couple of ways to do it, especially in the face of a conflict, not only two wars now going on, but a conflict that we really have no insight into as to where it goes. And obviously the channel to watch is oil prices and seeing what spikes there, but you probably don't get a material shift unless you start to get more involvement or more clarity on what Iran's position is from here.
All right, so there's geopolitics, there's earnings, there's the higher for longer narrative, or at least high for longer narrative.
There's a lot.
What is the biggest challenge for the market right now?
Oh gosh, I would probably say all of the above is the catch-all, right? The easy answer.
I didn't give you that as an option.
I think that geopolitics aside, because that's always kind of a looming issue, probably the interest environment, because I think now that we're getting a couple of years after this Fed tightening cycle, some parts of inflation are still taking longer to get back down. The fact that the wage story still hasn't been solved in terms of what the Fed has been comfortable with from a wage growth standpoint. I think you're going to have to start thinking about what is this readjustment and what are we going into in terms of a secular period. Is it longer rates, or is it rates higher for longer, or are we going to go back into and slip back into that lower growth, slower for longer that we got so used to? Our sense is probably not. You probably have more of a volatile inflation and economic backdrop in front of us, but too soon to tell. So I think just right now, embrace the normal for what it is. The fact that rates have risen, the fact that volatility is back in multiple pockets of the market, and actually being driven by something like currency and bond volatility, not as much equity volatility this year.
All right, we have to leave it there. Always appreciate your insights. We'll keep an eye on Breath Russell, a top performer today, so we'll see if it can continue.
Thanks, Caroline.
Kevin, thanks so much. It's Kevin Gordon of Charles Schwab.